We are now ready to look at Chapter 3, which is the adjusting process. So Chapter 3, as I mentioned, is the last chapter for our first exam. So we have 14 chapters we're going to cover this semester. We have 5 exams. 4 of the exams then cover 3 chapters, and exam 4 covers just chapters 10 and 11 on liabilities. So next week, as we're finishing up Chapter 3, we will take a look at the exam and talk about how to prepare for the exam and what to expect and what's on there and so on, just so you're ready for that. As you can see, we have several learning objectives for this chapter. I could summarize them in a much more succinct way, that we are going to be looking at various kinds of adjustments. So we'll start out talking about why we do adjustments in the first place, why these entries would not already be in our records when we reach the end of an accounting period. And then at the end of the chapter, we will look at what do we do once we have those adjustments in place, preparing the adjusted trial balance, using that to prepare the financial statements. And then we'll briefly mention, but not really work on, using vertical and horizontal analysis to evaluate a company's performance. We save most of that financial statement analysis for the final chapter of the semester, which not coincidentally is called financial statement analysis. So we mention it routinely as we work through many of these chapters that we're covering, but we don't actually do much of that until the end of the chapter, at the end of the semester, excuse me. So we'll start out with talking about why do we have to do this in the first place. And the reason that we need to do adjustments is very simple, because GAAP, G-A-A-P, Generally Accepted Accounting Principles, require, it's right down there at the very bottom of this slide, GAAP requires that you use a process known as accrual accounting. Accrual accounting is contrasted with cash basis accounting. So cash basis accounting is pretty simple. Someone pays us cash, we record it. We pay someone else cash, we record it. What you see on our financial statements is based on the receipt or spending of cash, those cash flows. If we used cash basis accounting, which we can't as a publicly traded company, but if we did, there would be very little reason for having a cash flow statement, because the cash flow statement would basically mirror what we see on the income statement. However, we as accountants, as financial accountants, our job, remember from chapter 1, the whole reason we do this is to give decision makers information about our company so that they can make an appropriate decision about our company. So it's important that we give them the information that's representative of what really happened inside our company, not just did we spend the cash, did we receive the cash. So we're trying to get a better match on our financial statements of what really actually happened in our accounting, or excuse me, in our business during this particular period. So we talked about in the very first chapter the idea of going concern, that we assume corporate form of organization. The company has a potentially unlimited life, but we need to divide that life into smaller units and report on those units. So for most publicly traded companies, well, they might be preparing financial statements on a monthly basis for their internal decision makers. They share those with the public on a quarterly basis. They provide information to the SEC, Securities and Exchange Commission, on a quarterly basis, and those are called the interim financial statements. And we prepare and have audited an annual report as a publicly traded company. So we want to make sure as we prepare those quarterly and annual financial statements that we're accurately summarizing the transactions that actually took place for that company, again, regardless of whether cash changed hands or not. Very quick example, in that exercise, we were just looking at the Rocky Mountain Tour or Travel Agency in Chapter 2. The revenues that they reported, $20,500 worth of revenues. If you think back to that exercise, we just did those journal entries. We reported the revenues before our customers had paid us anything. We reported the revenues because we had earned them, and we'll talk about in this chapter, well, how do we know we'd earned them? But for now, up to this point, we've just said, okay, they earned the revenues, now record them. Remember, in that Rocky Mountain Travel Agency example, we recorded the revenues as soon as we earned them before any of our customers actually paid us. And then later on in the month, the customers paid us $13,100 of the $20,500 that we had earned. We calculated, when we did that unadjusted trial balance in exercise 9, we calculated their net income based on what was on that trial balance, and we said their income was $12,000 and change. That was based on the revenues they earned, not just the $13,000 that our customers had paid us. If we used cash basis accounting, we would only have reported the $13,000 that our customers had paid us, even though we had earned over $20,000. So hopefully you can see that difference, why that's important, that we use accrual accounting, that we report revenues when we've earned them, and then we match against them the expenses that helped us to generate those revenues, regardless of when the cash changes hands. If we used cash basis accounting, we wouldn't have an account such as prepaid rent or prepaid insurance. If we paid for a year worth of insurance under cash basis accounting, we would report that entire cost at the time we made the payment, even though the insurance is for a whole year. If we paid our rent 6 months in advance, we would report the entire cost at the time we made the payment. And then for the next 5 months, we'd be reporting nothing. The whole point of accrual basis of accounting, and you'll hear me say this over and over, it probably comes up in every single chapter. So I'm going to put this on the screen. And I'm going to put it in a color that's going to stand out here. Put it right across the bottom of the screen. And it is the matching principle. The matching principle is the basis for accrual-based accounting, and it's the reason or the explanation for a lot of what we do. And here's my summary of what the matching principle says. Record revenues. When earned, and then match expenses against those revenues. Against those revenues. So you'll hear me say this over and over. We do this because the matching principle says that's how to do it. Because our goal, our whole purpose, is to give decision makers good information so that they really know what's happening inside our company. And the way we do that is by using the matching principle. Record revenues when we've earned them, then match against them the expenses that go with those revenues, regardless of when or whether cash has changed hands. All right. Any questions about that so far? It's really the explanation for everything we're going to do, certainly in this chapter, is to make sure that what's on our financial statements is what occurred this month or this quarter or this year, regardless of when or whether the cash has changed hands. So we'll start with that first phrase of the matching principle. Record revenues when we've earned them. Well, how do we know we've earned them? There is a 4-step test to know whether we've earned the revenues. And I'm going to explain that test to you right now. So 4 steps for revenue recognition. You may not see these in the book in the same way that I'm giving them to you, but this is the way that I want you to think about it. Okay. We have an agreement between the buyer and the seller. We have an agreement between the buyer and the seller. Yes, I want to buy that. Good, I want to sell it to you. Doesn't have to be a written agreement. It doesn't have to be a contract, written contract signed and notarized, although sometimes it might be. It can be a handshake, but there's an agreement. We have to have a price that is fixed or determinable. And that kind of makes sense. How would we record a transaction if we don't know what the dollar amount is? We don't know what the value is. So the price has to be fixed or determinable. We have to have delivered the product or performed the service, whatever we're selling to them. Delivered the product or performed the service. How do we know if we've delivered the product? Well, it's part of the agreement between the buyer and the seller. At what point is it considered delivered? So it may be, if you're in a grocery store and you're buying something, you're checking out at the checkout stand, it's pretty clear to know when you have purchased the product, right? You've scanned everything, you've put in your payment, and you're walking out of the store with it. That's really clear to know we've delivered the product, the store has delivered the product. But what about something like a large manufacturing company that might be working on some project, some large, I'm thinking about here in Olean and Siemens, formerly Dresser Rand, they might work on a project for a year or 18 months. And then it's done and they load it on a truck or they load part of it on a truck, and the truck has to transport it from Olean, New York, maybe to the port in Baltimore or to LA, to the port in LA. Hopefully they're not going there today, or to the port in Houston, Texas. They're taking the product hundreds or thousands of miles, and then it's going to be loaded on a ship and possibly shipped to Europe or to South America or to the Far East. And then it's going to be offloaded from the ship and transported overland to its final destination. So for that product, how do we know when it's been delivered? Well, the way we know is the companies, the buyer and the seller, have an agreement. Back to number one. They've decided, they've agreed, once it's, and it could be any one of those points that I just described. It could be once it's on the truck in Olean, once it leaves the facility in Olean. It could be when it reaches the port and goes over the rail and it's loaded on the ship, the cargo ship that's going to take it wherever it's going. It could be when it's received by the customer. But there's an agreement, and both the buyer and the seller have agreed, where does that transfer take place? And if you've ever driven here in Olean, if you've ever driven down Wayne Street in Olean near the end of a month or near the end of a quarter, and you've seen one of those huge 18 trucks, 18 axle trucks with a huge boxed up thing that's tarped and bungeed down and so on. And you see it sitting outside in their drive area. And I'm looking around the room here, wondering if probably some people in the room have actually seen that. And the reason that they're sitting out front like that, and it again usually happens at the end of a month or end of a quarter, is because the agreement between Dresser Rand or Siemens and the buyer is once it's shipped, once it leaves their facility, it's considered shipped and they get to claim the revenue. And the rule then is once it goes out of past the guard shack, the controlled part of the property, it's loaded on the truck and it's sitting outside their controlled booth, it's considered shipped and they claim the revenue, even though it might still be sitting here in Olean for a couple days. That's why you see that at the end of the accounting period, because they want to book that revenue because of these exact rules that we're discussing. because the agreement is if it's loaded and ready to go, you can claim the revenue. And at the same time, the buyer has to report the expense. And that's why it's important that there's an agreed upon point. You can't have the seller claiming the revenue, but the buyer not claiming the expense. It has to match. Last one. This is the one that we just assume is going to be present unless we have evidence to the contrary. Reasonable assurance of collectability. So what does that mean? If we allow our customer to buy on credit, we assume they're going to pay us. And so, certainly in most cases, we probably would not be selling to a customer if we didn't expect the customer to pay us, right? We assume that this one's in place unless we have evidence to the contrary. So that's the one that we would talk least about in class. But when we get to chapter 8, I think it is, on receivables, chapter 8, we'll talk more about that. Well, what if our customers don't pay? What if we allow them to buy on credit and then they don't pay us? How do we handle that from an accounting perspective? So this is the 4-step test that I want you to keep in mind whenever we say we've earned the revenue. How do we know we've earned it? Because we've done what we said. We have a price and we have an agreement. And then we can record the revenue. And then once we record those revenues, we need to think about, okay, what expenses helped us to generate those specific revenues? We shipped that job, we claimed the revenue, what costs went with that job? And that's where the expense recognition principle comes into play. Again, it doesn't matter whether we've actually paid the cash. We may have paid the cash out before or after or during that same accounting period. It doesn't matter because we're not doing cash basis accounting. We are using accrual-based accounting, and the matching principle dictates whether something belongs on our financial statements or how it belongs on there. So at the end of each period, we prepare that unadjusted trial balance as we just did in exercise 9 in chapter 2. And we look at that and say, what's on here that shouldn't be? And what's not on here that should be? And that is the reason or the explanation for all of the adjustments that we do. Because something's on there that shouldn't be, or something's not on there that should be. And with that, we are going to go to our exercises, because I don't think we need to spend a lot more time talking about this. I think we can just go ahead and do it. So most of the exercises that we're looking at in this chapter, most of the exercises are looking at various common, typical adjusting entries that most companies will need to make. So let's go to our exercises. Our first exercise then, I'm giving you just a moment in case you didn't already have the chapter 3 exercises ready. Our first exercise is one that, as you can tell looking at it, this comes in that category of multiple choice. And for each one of these 8 examples, I know you could just go down and pick off the list and change your answers until you get them right. But I want to talk about some of these. And so we're going to go through these together just because it gives us an opportunity to discuss why and how adjustments would happen. And some of these, many of these, are adjustments that we are then going to practice with as we go through the next several exercises. So, first one, a 2-year premium paid on an insurance policy. We've discussed that specific example in an earlier class. That is an example of a prepaid expense. So from an accounting standpoint, here's what would happen. We paid for the 2 years worth of insurance. But the insurance is then going to benefit us over the next 24 months, right? So when we pay for it, we don't want to record the entire expense in that same period. If we used cash basis accounting, that's what would happen. We would record the entire 2 years worth of expense for insurance in that 1 month. But that doesn't give us a very accurate picture of what's happening inside our company, because that 1 month we've vastly overestimated, overstated our insurance cost. And then for the next 23 months, we show no insurance cost at all. Because we use accrual-based accounting, what we would do then is report the full 24 months as an asset, prepaid expense, and then each month we would take 1/24 of that cost and move it off the balance sheet. It's no longer an asset for us because that month of coverage has expired, and we would move it onto the income statement as an expense. So it goes from being an asset to an expense as each month passes, as each accounting period passes. Fees earned but not yet received. So frequently you'll hear the terms accrual and deferral. Now, this textbook tends not to use the word deferral quite as often, but accrual in general means that we're pulling something into the current period, and a deferral means we're pushing it off to a future period. So when we've earned these revenues, but our customer hasn't paid us, this is exactly what we talked about with the Rocky Mountain Travel Agency, travel, whatever it was, in chapter 2. We accrued those revenues by recording the revenue even before our customer paid us. We pulled it into the current period, even though the cash hasn't been received yet. How about when our customer pays us, but we haven't earned it yet? That's an unearned revenue. So the example that I typically use this time of year is maybe you've paid someone to plow your parking lots at your business every time it snows. And so maybe you make a payment at the beginning of the season to secure their work, because sometimes it's really hard to get reliable people to plow for you. And so maybe you pay them in October to provide that service to us over the next 6 months or however many months it keeps snowing. And so if you think back to that 4-step test, we have an agreement, we've been paid, but we haven't performed the service yet. We haven't earned it until we actually plow their lot or until the time passes. So maybe if it's a 6-month payment, we're recording it 1 month at a time as earned. But for now, when the customers have paid us, but we haven't held up our end of the deal yet, it's an unearned revenue, which is a liability for us. Salary owed, but not yet paid. And again, you'll see this in one of the examples that we do, one of the exercises coming up. It's an example of an accrued expense. We reported the expense because it went along with the revenues from that period, but we haven't yet paid it out. So we need to record the liability to pay our workers in the next accounting period. Subscriptions received in advance by a magazine publisher is another example of an unearned revenue. If you've ever purchased a subscription to a magazine or any online service where you pay in advance, maybe for 6 months or a year at a time, then you know how that works. You pay up front and then they owe you something for the next period. For, they need to mail you your magazine every week for the year, or they need to allow you access to their streaming service for the next 6 months or whatever. Supplies on hand. We've already actually talked about how most companies do supplies, that when they buy the supplies, they put them into that supplies account. And then at the end of the period, they look at it and say, how much of this did we actually use? And at that point, they move it on to the income statement as an expense. So supplies really represents a prepaid expense. Taxes owed but payable in the following period. So I think because it's February and tax season just opened for personal income taxes for the 2021 tax year. I think everybody gets how this works. If you're a business, you have to also pay those same type of income tax if you're a corporation. The corporation is liable for taxes. So if you use a calendar year for financial reporting, your taxes might not be due, say, till March 15th. But when you prepare your financial statements for 2021, ending December 31st, 2021, you need to record that expense on your financial statements, even though you're not going to pay it for another couple months, potentially. And so taxes owed but payable in the following period represents an accrued expense. You need to report that expense in the right year, even though you don't have to pay it for a couple months after that. And the last one, same idea. Maybe you get a bill that covers the period of, what month is this, February 1st to the 28th, but it's not due until the middle of March. If we were doing our financial statements for the month of February, you'd want to have that utility expense in there. You would need to, even though you're not going to pay the bill until the next month when it comes due. So these are just some very common situations. As I said, many of these we're going to see again in an actual, in an exercise that's coming up. We'll see how do we actually do that. But for now, just a familiarity with the terms and some of the reasons that we might need to do accruals or deferrals. Report things in periods other than when the cash actually changes hands. Any questions before we move on to our next exercise? So I'm going to, I think, maybe set up some T accounts here. So we can think about what's happening. And even though this exercise does not give us any dollar amounts, I'm just going to make some up because I think it's easier if we talk about it with actual numbers rather than just kind of in theory. So I'm going to put unearned rent and rent revenue and cash here. I'm going to read what it says happened. I'm going to make up some numbers, put them in the T account so we can see what this would look like. At the end of October, the first month of the business year, the usual adjusting entry transferring rent earned to a revenue account from the unearned rent account was omitted. So let's talk about what has already happened at this point. We must be a landlord. We have some rental property. And maybe we have agreements with our tenants that they will pay us 6 months in advance. Maybe we give them a break for paying in advance. Or we charge them an installment fee, charge them a little bit higher if they want to pay month to month. And so this is what happened in my imaginary world. We have somebody who's renting a, I don't know, maybe it's a storage locker. I'm going to use a small number. Let's say they had paid us in advance for 6 months of this storage locker at $200 a month. I have no idea if that's realistic. Doesn't matter. Whatever they're renting from us, they paid 6 months in advance, $1,200. Every time cash changes hands, it must be recorded. If we receive cash, we must record it. If we pay out cash, we must record it. In our adjusting entries in this chapter, keep in mind that we never adjust cash. There will never, ever be an adjusting entry that includes the account cash. We can't adjust our cash. Either we have it or we don't. Okay, we don't get to the end of the month and say, gee, I think we should have a little more cash. Let's just adjust that a little bit. Clearly not ethical. So here's where we are when October starts. We have recorded $1,200 in unearned rent because we have a liability. Remember, it's a liability. We owe $1,200 worth of rental space to our tenant. So when we get to the end of October, we've now earned 1 month of that, right? $200 using the amounts that I suggested, $200. So what should have happened? Let me get this a dark enough color that you can see it. What should have happened? We should have moved $200 out of that liability account into the earned revenue account. The blue transaction that I just included there, a debit to unearned rent, a credit to rent revenue, is what should have happened. Because the month of October passed, they used the space that we were renting to them, and we've now earned that $200. Everyone understand that so far? What we're told in this exercise then is someone forgot to make that entry. And we're asked to explain how leaving out that blue entry would impact our financial statement. So the title of this exercise is the effect of omitting that adjusting entry. What happens if we just don't do it? So what happens to our rent revenue? Oops, let me get rid of that. Is our rent revenue, if we didn't include that $200 in rent revenue, is our rent revenue over or understated, or is it correct? It's understated. Yep, we're missing that $200. And if we're missing $200 worth of revenue, then our income would also be $200 lower than it should be, right? Okay, so we just understated our income because we understated our revenue. How about on the balance sheet? So this unearned rent, remember, is a liability. If we didn't include this blue adjusting entry, the balance in our unearned rent account would still show at $1,200. How much rental space do we actually still owe them at the end of October? What should the balance in that unearned rent account be? That's just $1,000. So if we don't make that adjusting entry, the unearned rent account, that liability is overstated by $200. And because our income was understated, our stockholders' equity will also be understated. Nothing happened in this case, nothing happened with our assets. We had the $1,200 in cash. So that didn't change. The adjusting entry adjusted or corrected or fixed the liability and the revenue. The liability is on the balance sheet, the revenue is on the income statement. It makes both of those financial statements incorrect, misleading. We're giving faulty information to our decision makers, and based on that, they might make a poor decision about our company because our company looks like we owe more than we actually do and looks like we're less profitable than we actually were. Make sense to everybody? So what you will see for each one of these adjusting entries, my check marks in there. For each one of the adjusting entries that we're going to look at, what you're going to see is that the adjusting entry impacts both the balance sheet and the income statement. So when we talked about journal entries in the final exercise for chapter 10, for chapter 2, exercise 10 for chapter 2, we know that every journal entry must include at least 2 accounts, one debited, one credited. All those rules we talked about for journal entries have to have a date, have to have at least 2 accounts, debits and credits have to be equal. All of those things also apply to the adjusting entries, but we have two additional rules that apply to the adjusting entries. Two additional rules for adjusting entries. And here they are. Never adjust cash. Your cash account should never be part of an adjusting entry. If it is, it's automatically wrong. Cannot adjust cash. And we must include at least one balance sheet and one, income statement. I'm having trouble with typing today. All of our adjusting entries must include at least one income statement and one balance sheet account. And what you will see is that they're logical pairs. So in the exercise that we just looked at, the two accounts were unearned revenue and earned revenue. Unearned revenue from the balance sheet and earned revenue from the income statement. Clearly, there's some kind of a relationship between those two, right? Once the revenue has been earned, we need to move it out of unearned and into the regular revenue account. You will see that for all of the adjustments that we do, that there's a clear relationship between the two accounts, one on the balance sheet and one on the income statement, that they're a logical pair. They make sense. They go together. Let's talk about our next exercise. Does anyone have any questions at this point? Whoops. Sorry, that one's not quite straight. Okay, so again, I'm going to put the T accounts here on the screen so we can think about what this would look like. And this deals with prepaid insurance. So prepaid insurance is one of those prepaid expenses. It's an asset account, and so that's on the balance sheet. The related account on the income statement, you can probably guess, would be insurance expense. Okay, clear relationship. Prepaid insurance on the balance sheet as an asset. Insurance expense, as the insurance expires or time passes, it becomes an expense on the income statement. So this says at March 31st, end of the first month of operations, the usual adjusting entry transferring prepaid insurance expired to an expense account is omitted. So again, just like in the last exercise, I want to talk about what already happened. We already bought that insurance policy. And let's say it's a 1-year insurance policy and we paid, I don't know, $600 for it. At the time we bought the insurance policy, we used cash to do that. So we credit cash, we used cash, and we record on our balance sheet this asset, prepaid insurance. So 1-year policy, $600, that's $50 a month for this insurance. At the end of the month, what should have happened that we're told did not happen? They should have moved that 1 month worth of cost off the balance sheet and onto the income statement. So the entry that I just put in green on the screen is what should have happened and we're told did not happen. Does that make sense so far? At the end of the 1 month, we've recorded 1 month, $50 worth of expense, or we should have, and we've reduced the value of the asset remaining on our balance sheet because now we only have 11 more months of insurance. So what happened? If we left off that green adjusting entry, what happens to our insurance expense? Is it under or overstated, or is it correct? We have too much insurance expense, not enough, or is it the right amount?
Understated.
Thank you. It's understated. We don't have enough because we left out this $50 worth. Now, there might be other insurance expense in there, but we just missed this one. So if we don't put enough expense on our income statement, is our income too high or too low, or is it correct?
Overstated.
Our income is overstated because our expense is understated, right? So think about how we calculate income, revenue minus expenses. If the expenses are too low, then our income would be too high or overstated. How about on the balance sheet? Our prepaid insurance still says we have $600 worth of insurance out there, but we really only have $550 left, using my numbers. So our asset, prepaid insurance, is also overstated. And because our income was overstated, our equity will also be overstated. Remember, the cash account is correct. So this is a pretty serious thing, to omit the adjusting entries, because it makes both our income statement and our balance sheet wrong. Now, what you'll notice is they're wrong in the same direction, right? So in the last exercise, when we were looking at the unearned rent account, if our liabilities were overstated, our income was understated. Here, when our expenses are understated, our income is overstated and the equity is overstated. So in this example, because we left that expense off, our assets are too high. That makes us look better than we are. And our income was also too high, making us look better than we are. So the error goes the same direction on both financial statements, is what I'm trying to say. Either they both make us look better than we are, or they both make us look worse than we are, because of this pair of accounts that both are wrong, if we leave that entry out. Let's go ahead and get the green check marks in there. Any questions at this point before we move on? Any questions? I'm going to ask you to try this one on your own. And I'm going to pause the recording, let you think about it for a minute. If it's helpful, draw out your own T accounts and think about what's happening here. I'm going to pause for a minute. And when you have thought about it and come up with your answers, go ahead and restart the recording. So in exercise 4, it tells us that we forgot to accrue wages at the end of July. And we'll be talking about this in maybe even the next exercise. But what happened here? Well, when most of you, maybe all of you, have probably had a job or currently have a job at some point in your life. So when you have a job where you are a regular employee, when do you get paid? If you have a job right now, when do you get paid?
End of the week.
End of the week, so every Friday maybe. Anyone else? Other pay schedules? Every Thursday? Every Wednesday, every Thursday. I get paid every other Friday. My husband also gets paid every other Friday, but it's the opposite Friday from when it's not the same day I get paid. Is there anyone who may have been in the military? Military usually get paid like the first of the month, 1st and the 15th. Sometimes salaried positions get paid like the 15th and the last day of the month. So if you get paid every Friday or every Thursday or every Wednesday, has it ever been the case that your employer has come to you and said, here's your paycheck? I know it's, let me think back to last week. So February 1st was Monday, right? No, Tuesday of last week. Okay, so January 31st was on a Monday. If you told me that you get paid Wednesday or Thursday or Friday, did your employer come to you on Monday, the January 31st, and say, here's your paycheck for the last couple days in January? Because it's the end of January. I know you get paid on Wednesday or Thursday or Friday, but I'm going to pay you early because the month is ending. Does that happen? Now, I've been working for a lot of years and I've never once had my employer say, here's your paycheck early because the month is ending. And I've been teaching this for 20 years and I think I've had one person ever say, yeah, I had that happen one time. But it was a small private business that the owner just really was trying to clean up the books. So if your pay period corresponds with the week, the day of the week, it likely doesn't usually correspond with the end of a month, right? Because there are 6 other days of the week that the month could end. So virtually every company has to do this type of an adjusting entry because July was ending, but it didn't end on a pay period day. It didn't end on the Wednesday when they pay their workers or whatever. They must then accrue the expenses that have been incurred, the cost that's been incurred since the last time they paid their workers. And this is what the entry would look like, the blue that's on here. A debit to the expense and a credit to a liability, wages payable. Again, you can see the connection between this income statement account, the expense account, and the balance sheet account, the liability. We owe our workers and we have to pay them. We're not paying them early just because it happens to be the end of July and we're closing our books. We're still going to pay them on Wednesday, or Thursday, or Friday, or whatever day we always pay them. But it's important that our records are correct for the month of July, and it includes all of the cost of employing our workers. And that's why if we leave out that entry that I put in blue, our wages expense would be understated, so our income would be overstated, and our wages payable liability would be understated, and so our equity would be overstated. Everybody good so far? So hopefully at this point you're getting the idea of why we need to do some of these adjusting entries and why it matters if we don't do them, because it makes our financial statements wrong and therefore potentially misleading. If our whole job is to give decision makers accurate information so they can make an appropriate decision about our company, we need to make sure that we have as much correct and complete information in the records as we can. It doesn't mean we have to pay our workers early, but it does mean we need to record that we owe them. For our next exercise, and we will probably, I don't think we'll get through this whole thing in the 13 minutes we have left, but we'll see how far we can get. And if we don't finish, we'll just pick up here next class. So what we can see on this exercise at the top are 2 trial balances. We have the unadjusted trial balance, that's these first 2 columns, and then we have the adjusted trial balance. And so for this exercise, our job is to look at the differences between those 2 sets of numbers and record the journal entry. So there are 5 differences. There are 5 adjusting entries that we're going to be able to pick up by finding where the dollar amounts, the values are different from the unadjusted to the adjusted trial balance. And so we're just going to go down the list. And so we have accounts receivable that we can see there's a $6 difference. Our accounts receivable went up by $6. So we know we're going to have a $6 debit to accounts receivable. It's nice they use small numbers for us here. Makes it easier. So why would our accounts receivable have gone from $38 to $44? Remember, accounts receivable means we've sold something to our customers on credit. So if our accounts receivable went up by $6, that would mean we just recorded in an adjusting entry that our earnings, our revenues went up by $6. And we can see right here at the bottom of the screen, the fees earned, that's our revenue account. It also went up by $6. So that's going to be our first entry, a debit to accounts receivable and a credit to the fees earned. for $6 each. What happened there? We billed our customers. We had met that 4-step test. We had an agreement between the buyer and the seller. The price was fixed or determinable. We delivered the product or performed the service that we agreed to, and we believe our customers are going to pay us in the future. And so since we've earned those revenues, we want to report those revenues. The fees earned is the revenue account on the income statement, and the accounts receivable is the asset on the balance sheet. So that's the logical pair of accounts. If our revenues increased but our customers haven't paid us, our receivable also went up. Everybody okay with that one? Okay. So let's just keep going then. How about our supplies? What happened to our supplies account? Very next line. What happened to the supplies account? It went down by $2. What's the logical pair? What goes with supplies on the balance sheet? So we know we're looking for an income statement account. So we're from fees earned down through miscellaneous expense. Those are all the income statement accounts. Which one of those logically goes with supplies? Supplies expense. Supplies went down by $2. Why? Because we used them. And so our supplies expense goes up by $2. A debit to supplies expense and a credit to supplies for $2. We've talked about that a couple times now, how most companies handle their supplies account. When they buy supplies, they just add them to the supplies account. And at the end of the period, they either calculate or estimate how much they've used up, and they make an entry just like we see here in number 2. Report the expense for the supplies that they've used up and reduce the asset. Again, that pair of accounts, one on the balance sheet, one on the income statement, they just seem to go together. There's a relationship. If we don't have the supplies anymore, must we use them, and we need to record the expense. Stop me if you're not sure what's going on. How about our next line, prepaid insurance? What happened to prepaid insurance? It went down from $20 down to $8. It went down by $12. It has a debit balance. It's an asset. It has a normal debit balance. So to make it go down from 20 to 8, we would need to credit prepaid insurance for $12. And I'm going to go ahead and put that in down here. Prepaid insurance went down, credited $12. So we know we need a debit to some related account. Prepaid insurance is an asset. It's on the balance sheet, so we know the other account must be on the income statement. What's the related account here? Insurance expense, exactly. So as time passes and that insurance policy lapses, we need to record the expense. We need to move it off the balance sheet. It's no longer an asset for us and onto the income statement as an expense. What's next? Land stayed the same. Equipment stayed the same. But the accumulated depreciation on the equipment did not stay the same. It went up. We have not talked about accumulated depreciation yet, and we will talk about it more. We have an exercise coming up that we'll get to next class that deals specifically with depreciation. It is exercise 9. So we'll talk more about that specific account on Wednesday in our next class. But for today, for this exercise, we can see that the accumulated depreciation went from 8 to 12, and that has a credit balance. So it went from $8 credit to $12 credit. The way that would happen is by crediting that account an additional $4. Again, for this exercise, I'm asking you to just trust me, believe me, that this asset is a type that we haven't talked about yet, and it has a normal credit balance. It's a balance sheet account, it's not a liability. Accumulated depreciation, the associated account on the income statement is right here, depreciation expense. That has a debit balance. It went from $0 to $4. So we need to debit depreciation expense, $4. And we'll talk more about that whole concept on Wednesday. If you think back, I didn't specifically point it out, but if you think back to the learning objectives for this chapter, there was a whole learning objective that mentioned depreciation. And we'll spend a little bit more time on Wednesday talking specifically about that in exercise 9. Accounts payable stayed the same. Wages payable went from $0 to $2. Wages payable is a liability, so it has a normal credit balance. When it went from 0 to 2, it was because we credited wages payable $2. And we've already seen in the earlier exercise today, the associated account with wages payable would be wages expense. And this would be an accrual of an expense at the end of the period because the pay period didn't happen to correspond exactly with the end of our accounting period, our fiscal period. And if you were to just go down through the rest of those, you can see that all the accounts we haven't looked at yet, the balances stayed the same. Common stock, retained earnings, dividends, rent expense, utilities expense, and miscellaneous, all of those stayed the same. They weren't adjusted. And so we have all of our adjusting entries here that we would have made to get from what we had unadjusted to the totals we had with the adjusted balances. So what do you notice? The adjusted trial balance actually has more accounts on it than the unadjusted, because on a trial balance, you only include the accounts that have a non-zero balance. So if we had just prepared the unadjusted trial balance, for example, wages payable would not be on there because you wouldn't show wages payable with a zero balance. You wouldn't show insurance expense with a zero balance. You wouldn't have shown depreciation or supplies expense with zero balances. We only include the accounts that have something in there. So the adjusted trial balance would have several more accounts on it than the unadjusted. What we'll talk about later on in the chapter is what happens at the end of the accounting period after we've done all of these adjustments. Then we have to prepare our financial statements, close the books to prepare for the next accounting period, in this case, the next month. And by closing our books, that means that all of the temporary accounts, so from here down, all of the temporary accounts, dividends, revenues, and expenses, all of those would need to be zeroed out. And that's called the closing process. We'll talk about it a little bit more. But the closing process means that after the closing, the only accounts that appear on the trial balance are the ones that are on the screen right now. I just scrolled all of the temporary accounts down. So you see just the balance sheet accounts, the permanent accounts, assets, liabilities, and equity. So we're going to stop there for today. Does anybody have any questions or comments or anything before I stop the recording for this part of chapter 3? All right. Thank you for being here, and I hope to see you all on Wednesday.